morning everyone, my name is Song Jin Wei. My number metric is 10DAT23M0003. I would like to introduce my team members. They are Nitya, Demisha, Lam and Jaya. Today I'm going to talk about the tutorial exercise. For the first question, discuss the introduction to audit procedure. Introduction to audit procedures, ISA 500. Audit procedure are the steps or actions that the auditors perform to gather the sufficient and the appropriate audit evidence. According to ISA 500, audit evidence, the main audit procedures include inspection, observation, inquiry, confirmation, recalculation, re-performance, and analytical procedure. This procedure helps the auditors to verify the truth and the fairness of the financial statement. Scenario 1. Inspection of records, documents, or the tangible asset. During the audit of Omega Manufacturing Sdn Bhd, the auditor checks the fixed asset register and the supporting purchase documents for the new machinery purchased during the year. The warehouses and delivery records are available, but the physical machinery cannot be found at the factory premises. There are several possible reasons why the machinery cannot be located. The first one is the machinery may still be in transit and not yet received by the company. The second is the machinery might have been delivered to another branch or site instead of the factory. The third one is the company could have recorded the asset wrongly in the fixed asset register. The fourth one is the machinery might have been returned or disposed of without proper documentation. The fifth one is there may be a possibility of fraud where the documents were prepared to support a non-existent asset. So in this case, the auditor should proceed using the inspection. The first one is trying to physically locate and inspect the machinery at the factory or other company locations. The second is examining such as purchase order, delivery order, and the supplier correspondence to confirm whether the machinery was delivered. The one is check the entries in the fixed asset register and accounting records to ensure accuracy. The fourth one is, if necessary, contact the supplier to confirm the delivery of the machinery. The fifth one is, if the machinery still cannot be found, the auditor should report this as a potential issue as a considered possible misstatement in the audit report. So in conclusion, based on this inspection, the auditor can confirm whether the machinery truly exists and is owned by the company. If the inspection does not provide enough evidence, further audit procedure should be carried out. The auditor must then evaluate the effect of the missing asset on the financial statement and the audit opinion. Scenario 2. Observation. During the audit with Sdn Bhd, the auditor observed the company's inventory counting process. It's noted that some warehouse staff both count and record the quantities without the supervision. The answer for this question is ISA 5 provides the guidance on the observation of the counting of the inventory. The auditor attempts a visible inventory count to observe if the compliance with the management instruction and the performance for the recording and controlling the result of the physical inventory count. Based on these circumstances, we can identify some weaknesses. So the weaknesses, number one is lack of segregation. The potential control weaknesses identified through observation is the lack of segregation. The same warehouse staff are responsible for both counting and recording inventory. This creates the opportunities for intentional manipulation or unintentional errors to go undetected. Second weaknesses is risk of bias or error. The potential control weaknesses identified through the observation is the staff may discount skip items or record incorrect figures, whether due to the carelessness, pressure, or fraud. Since both they control both step errors and are likely to be identified. So how the weaknesses affect the reliability of the inventory account? The first one is the risk of material misstatement. The inventory is often a significant balance in retail companies. Weak controls increase the risk that the recorded inventory does not reflect actual quantities, leading to possible misstatement in the financial statement. The second is need for alternative procedures. Because the observed process is unreliable, auditors cannot place full reliance on management account records. They may need to perform additional procedures such as independent desk count, reconciliation to stock records, analytical procedures to identify usual, confirmation with third parties if applicable. So that's all for my part. Now I pass to my team member, Temisha.